If you want to make money sports betting, this is the video for you. We are going to be talking about positive EV bets, right? This is how I've made hundreds of thousands of dollars betting on sports. In literally this video, if you internalize it, if you give me 5 minutes, if you internalize it, you're going to make a lot more money sports betting. So the first thing we need to do is we need to go through how do markets work? How do sportsbooks set odds? How do they move odds? Why are the odds set the way they are? Right? So what we can start out with is just kind of a simple example, and this may seem crazy, but bear with me, right? Imagine there's a bunch of different baseball card shops, and you're looking at this Barry Bonds baseball card, right? So you may go into one shop, and the way a card dealer works, as you probably know, the way a baseball card dealer works, or whatever, another dealer, a car dealer, however you want to think about it, is you may go in with a baseball card, and they'll say, hey, we'll buy this card from you for $180. And then maybe the next week you go into the shop and they're selling that same card they bought from you for $180 for $300. Right? So the goal of a card dealer or a car dealer, car, what's the difference, is to make that spread. They want to buy things for $180 below market value, and then they want to sell it at a higher price. And they're doing the job of connecting buyers and sellers, right? That's why they're able to earn this spread, is you're not selling directly to the end buyer. You're selling to the card store for $180, who then in turn is going to market it and sell it for $300. So essentially you can imagine if you go into a bunch of different, card stores, they're all going to give you different prices where they're willing to buy your baseball card, this exact Barry Bonds baseball card. They'll also have different prices where they're selling it, right? Maybe some card stores think they can get a higher profit margin on this Barry Bonds card. Maybe, they're located in an area where there's a lot of Barry Bonds fans or something like that. They've had high demand for Barry Bonds cards, so they think they can sell it at a higher premium. So what you're going to notice is, even though all of these card dealers have different bids and offers, different places they're willing to buy and sell, you can kind of take the midpoint from all of them, right? So for example, let's say DraftKings, some card dealer, his name is DraftKings, is willing to buy your card for $250, and then they turn around and they try to sell it for $25 higher, $275. What you can assume is this card dealer, they think that the fair value, the true value of this baseball card is the midpoint, which would be 262.5. Right? Then maybe the other card dealer, MGM, is a little more risk averse. They bake in more of a spread. So maybe they say, hey, we'll buy this card for $240, we'll sell it for $340. Well, the midpoint of MGM's market, where they're buying, where they're selling, is $290. Right? So that's their midpoint. That's their fair value if you take the midpoint of their market. So what you can do if you're trying to figure out, hey, what's the actual value of my baseball card, of my Barry Bonds baseball card, is you can look at the markets in the midpoints of the market, right, from all these different card dealers. So here we have like 10 card dealers, and then you can take the average, right? So on, MGM, they're willing to buy your card for $240 and they'll sell it for $340. So because they're willing to buy your baseball card for $240, they think fair value is higher, right? Because they're willing to sell that same card for $340, that they think fair value is lower, right? So the midpoint is $290. So the fair value, according to MGM, is $290. So long story short, if you take the midpoint of all of these different markets and then you take an average, you can kind of get to the point, that, hey, this baseball card is worth roughly $268. And that may not be perfect. I'm not saying that's exact, but that is the midpoint of 10 different data points, of 10 different card dealers, right? So I don't know anything about baseball cards, but looking at the markets, right, looking at all the different prices you can buy and you can sell this baseball card, if you told me, hey, on Prize Picks, they're selling this baseball card for $220, do you want to buy it? I'd be like, heck yeah, I want to buy this baseball card for $220. Of course I do, because I know the average in the market is $268, right? So you take the average from the market, you get $268 is the price of this baseball card. If I could buy it on Prize Picks for 220. Sign me up. I want to buy that baseball card. Right? And I could also, if I could buy this for 220 on Prize Picks, I could turn around and I could sell it to Pinnacle or BetUS has the highest price for $258. So you don't have to know anything about baseball cards, right? You're using markets and real-time data, real-time price data to try to figure out what the fair value of an asset, in this case a baseball card, is. So we can go over to stocks. Stocks, it's no different, right? The bid-ask spread, as it's called. So on FanDuel, let's say, hey, there's some stock exchange. The stockbroker's like, hey, we'll buy this stock for $15. We'll sell it for $16. Well, they're buying it for $15. They think the price should be higher. They're selling it for $16. They think the price should be lower. The midpoint is $15.50. So you take an average, once again, just like every dealer, you take an average of all the different prices in the markets, you get 15.9. That's the fair price for your stock. So if you told me, hey, you want to sell this stock for $17, I'd be like, yeah, I want to sell this stock for $17. It's trading in the market at an average price of 15.9, looking at all these other data points. If you told me, hey, do you want to buy this stock for $14? I'd say, heck yeah. Again, it's trading in the market at 15.90, right? So I'm using real-time price data to figure out, where the fair value of an asset is. So again, that's how markets work. Basically, if, let's say, the price of a stock, if there's outsized demand and more people are trying to buy a stock, this is just the way that markets work, then what sportsbooks will do is, FanDuel may say, hey, everyone's trying to buy this, so what we're going to do is we're going to start selling this for $17 and buying it for a slightly higher price, right? If there's outsized demand to buy an asset, then you'll notice the fair value will go up, right? And you'll see that on sportsbooks as well. So this is just the way that markets work, right? If everyone's trying to buy a stock, then people aren't going to sell it at as cheap of a price. They're going to take up where they're selling their stock. So your midpoint, your fair value is going to go up. But anyways, let's switch over to sports betting. And in sports betting, it's no different. People always think sportsbooks make money in some crazy way, right? I go to FanDuel right here. This is the bet I was looking at. They're not charging me a fee for betting on the Jazz or the Thunder. There's no fees on FanDuel, right? It's not like I place a bet and they're like, hey, you owe us $2. They make their money through this spread as well. In the same way a stockbroker buys stocks for 15, sells them for 16, that's essentially what they're doing for this Thunder Jazz game. Is FanDuel saying, hey, you can buy the Thunder for 118, right? Or for you can buy the Thunder for 118, and then the Jazz are minus 138. So that's a 20-cent spread. So it's a little more confusing, though, because sportsbooks, right, they're using odds. They're not using money. They're not using dollar amounts, which people are used to, right? They're not using dollar amounts. They're using odds, which makes everything more confusing to new sports bettors. But essentially, you can buy the Thunder, right? You can bet on them at plus 118, or you can sell the Thunder and bet on the Jazz at minus 138. So in the exact same way, there's a price, right? On stock exchanges, a lower price to buy, a higher price to sell. Like you can see right here, the stockbroker is going to sell you something for 16 and buy it for 15, try to make their $1 spread. It's the same thing on sportsbooks. So what positive EV betting is okay, we have these markets from all these different sports books, right? So what we can do is we can take a midpoint, and that's fair value, right? So essentially, FanDuel is baking in a spread of 20 cents into their market. So the midpoint, in this case, would be plus 128 minus 128. So according to FanDuel, the fair line for the Thunder would be roughly, and this is a little bit of an approximation, but would be plus 128. So you can either bet 100 on the Thunder to win 128 in profit, or the Jazz would be minus 128. So you can bet 128 on the Jazz to win back 100. So that's the fair value with the VIG removed. So FanDuel's model is pricing the fair line on the Thunder at plus 128, the fair line on the Jazz at minus 128. That's a market with no spread. This is a market with a 20-cent spread, so we're just removing that spread. We're removing the VIG. So as a positive EV bettor, all you're doing is you're taking the markets from all these sports books where you can bet on the Thunder and where you can sell the Thunder. In other words, bet on the Jazz, right? Betting on the Jazz is the same as selling the Thunder. These are equal and opposite outcomes. And what you can do is you can take the midpoint from all these sports books. So let's say DraftKings has the Thunder plus 110, minus 140. So according to DraftKings, the midpoint would be plus 125, right? So the fair value on the Thunder would be plus 125. So you do this for every sports book, and you take an average, and it would be plus 130.17, right? So what this means is the true price for the Thunder is plus 130.17. So if you can bet on the Thunder at odds above plus 130.17, your bet would be profitable. Your bet would be positive EV because you're beating the market consensus with no spread, right? You're beating the zero VIG, the no juice price from the market, and you're taking a consensus of a bunch of different sports books. It's not like we're just looking at one sports book, FanDuel. There's dozens of books, if not more. I mean, you look at OddsJam, I believe there's like 175 sports books or something like that, but even for this random tennis bet over 18 and a half games in this WTA match, you can see there's dozens of sports books posting lines, right? And all of these books have invested hundreds of millions of dollars into their ability to set lines. So as a positive EV bettor, all you're doing is you're looking at this real-time price data, this real-time market data, and you're finding soft spots on sports books, in this case Prize Picks, right, where you're getting an edge, where you're buying things, essentially, you're buying stocks for less than they're trading in the market. So we can go back to the PowerPoint briefly. And again, sportsbooks make money just like a stockbroker, just like a car dealer. They charge their spread. And right, these markets, right, real-time prices, sportsbook odds, encompass, first of all, everything sportsbooks know. So all available public information. Sometimes people will be like, oh, can't believe you're betting on the Warriors. Curry's out. That's already priced into the market. Sportsbooks know it and sports bettors know it. If all the smart people thought that the Thunder should be favored tomorrow, right? If every smart sports betting hedge fund, sports betting syndicate, all the sharp bettors with their models, if they all thought the Thunder should be favored, the Thunder would already be favored. This line would move down from plus 118 to, minus 130 or whatever. In the same way, when people say, oh, this stock should be at a higher price, well, if it should be at a higher price and the market agreed with you, it already would be at a higher price. That's how markets work. They're based on supply and demand. Sportsbooks don't want risk. They're constantly moving around their odds to balance supply and demand. Sportsbooks, they want to take balanced amounts of money on the Thunder at plus 118, the Jazz at minus 138, and make their risk-free 20-cent spread and have zero risk. That is what is ideal for a sportsbook, right? So essentially, we're using, real-time prices. It encompasses everything bettors know, all opinions from sports bettors, as well as everything sportsbooks know. So everything is reflected in the odds, right? In the same way, Amazon's stock price reflects everything about the company. Any public information is reflected in the stock price. Jeff Bezos has an affair on his wife, whatever, that's going to be reflected in the stock price. They hire a new CEO, that's going to be reflected in the stock price. It's all reflected in the stock price pretty quickly, right? Because markets are based on supply and demand. So LeBron gets injured, it'll be reflected in the odds quickly. So essentially, if you don't believe in positive EV betting, because a lot of people will comment on my plays and they'll be like, oh, you don't know anything about tennis. How are you taking the over 18 and a half games? Right? And the thing is you don't have to know anything about tennis. We have dozens of data points of sports books, again, who have invested hundreds of millions of dollars into their ability to set lines and price bets, and they're taking action from all around the world, constantly moving around lines, trying to balance supply and demand. They're doing the hard work for us. I'm just picking off Prize Picks when they're offering way too much value. And here, you can see, we can get this play at minus 119. when all the other books are pricing this around minus 140. It's like you have a bunch of stock dealers all saying, hey, we'll buy the stock for 140 bucks, and you can buy it at 119 on Prize Picks. Seems like a pretty good deal to me, right? So we're using real-time market data, which encompasses everything, right? Everything's priced into the market to find value on books. So unless you think you're smarter than the sports books, and they're $1 million models, and it's not just like there's one sports book posting odds on this tennis match. You have dozens, right? FanDuel, DRF, 4Wins, Pinnacle, Play Eagle, PointsBet, tons of books, tons of data points. So you have really high confidence that this line should be set around minus 140, and Prize Picks is screwing up and giving us way too much value at minus 119. So this is definitely a play we want to be on. Definitely. So let's go back here. And if you don't believe in positive EV betting, you essentially think you're smarter than every other bettor, right? Because if you're taking this under on Prize Picks at minus 119, when there's books offering plus 118, right? First of all, you're getting ripped off. You're getting a rip-off price. You're getting 37 cents below where Pinnacle is offering this line. But also, if you're not following market data, it means you think you're smarter than every other sports bettor. Because sportsbook odds, just like the price of a stock, reflect supply and demand from bettors placing wagers. If everyone in every sharp bettor and every syndicate were hammering this over, the line would move from minus 140 to minus 160. So unless you think you're smarter than the sportsbooks and you're smarter than other bettors, you should just follow the market. And because books set lines independently, they have different odds from one another, you can just pick off books when they're screwing up. That's what positive EV betting is, right? So in this case, it's literally as simple as placing the bet in bold that's highlighted in green. So in this tennis match with a 1.58% profit margin, we'd want to hit, Samsonova over 18.5 games on Prize Picks. We're getting minus 119. All the books are pricing it around minus 140. It's really that simple. Value-oriented sports betting, data-driven sports betting. We're just picking off sports books, essentially, in the same way with the examples we went through, right? If all these, different stock exchanges, you take a midpoint of all their markets, you take an average, 15.9, you want to buy that stock for $14? I don't know anything about the stock, but yes, sign me up to buy it at $14, given it's trading at $15.90 in the market, and there's dozens of data points telling me it should be at around $15.90 in the market. You tell me I can sell all my stock at $18, I'm selling it in a heartbeat. Not because I know anything or I have an opinion that the stock is going to go down, but because of the markets on every other, stock exchange. So that's positive EV betting. It's the most important concept in sports betting. Please, let me know your thoughts on this video. Let's make money.